The so-called DEGIRO Core Selection is a selection of over 200 ETFs that you can buy with actually lower transaction costs, allowing you to achieve a higher net return. Now, since the last update was about 5 years ago when we talked about the DEGIRO Core Selection and the best ETFs from it within Happy Investors. So, it's time for a new update, although some of these ETFs are still part of the current DEGIRO Core Selection and still qualify as, let's say, the best selection. Now you should know there are pros and cons to this DEGIRO Core Selection, so don't go in blind. You don't necessarily have to buy within that core selection. It's also kind of a promotional tool from DEGIRO. Keep that in mind if you see a much better ETF that doesn't fall within the core selection but fits you well, according to your risk profile. Go for it! In this video, a selection of the potentially best ETFs for the long term. We take different risk classes into account, so we start with relatively low risk and build up to relatively high risk, with the last group of high risk usually being among the better ETFs. However, the time interval is different. With low risk, it's more about passive, simple investing, like making a monthly contribution and not looking at it too much. With the higher ETFs, which come with higher risk, there's actually a shorter time frame involved, where at certain times you really want to buy a lot, and at other times, when the price is going up a lot, you actually want to take a little profit. Sounds really simple in theory, and it actually is. And in the year 2025, this is actually a moment when you should cash out a lot and maybe even keep some cash reserves, but you shouldn't invest too much in these high-risk thematic ETFs. But in practice, it turns out to be really difficult because what do you need for that? Not so much substantive knowledge, but especially emotional discipline to stick to a solid strategy. It's all up to you in this video, the potentially best ETFs within the DEGIRO Core Selection, and after 11 years of investing, I'll give some updates here and there about what I think is useful regarding certain ETFs, whether to go all in or not. In general, be careful with what you do. Know the investments you make and keep in mind that you can lose money. Not just in the short term, but also in the long term. It can happen that if you enter at the wrong moments, it takes a long time before you see any returns. And we take that into account in this video. Have fun. Don't forget to visit our website, Happy Investors. There you can download all sorts of free downloads, booklets, an ETF book, a stock book, a starter kit, but also a calculator to help you calculate your financial freedom with returns, inflation, monthly contributions, and more. Thank you. It's all free. Have fun. And if you have any questions, just let me know.
Let's start with a little bit of the basics about what the conditions and costs are for core selection, plus 2 handy little tips. You can find an overview of the ETF core selection on DEGIRO's website. You also see the disclaimer. With investing, you can lose your investment. Always keep that in mind. Essentially, with the ETF core selection, DEGIRO pays the commission fees, and what's left is just €1 in handling fees. But be careful, currency and other possible costs such as spread costs are also added. Show ETF buying, selling, conditions on DEGIRO, fair use policy, €1 fee for monthly core selection ETF. Now, there are a few conditions you need to understand, and for that, you can scroll down a bit on DEGIRO's website, and then we'll see an example of what they call the fair use policy along with their conditions. Actually, there are 2 conditions. If you just buy an ETF within the core selection once a month, you only pay that €1 in handling fees. However, if you buy the same ETF twice, the transaction must be in the same direction. So for example, buy or sell twice. And the value of the second transaction also has to be higher and at least €1,000. So that's quite a hefty amount. So if you click on examples, you'll see an example. When you buy for the first time in the month, you buy for €750. Well, that counts as a purchase. So you pay €1 in fees. The second purchase has to be over €1,000. It's not exciting if you invest monthly in ETFs. The third time doesn't count anymore because you're buying an amount lower than that €1,000. So you'll still end up paying those commission fees. It's not all that exciting, especially if you're just going to invest monthly in 1 or more ETFs. Then it's really not that thrilling. You can best see those rates and costs on the rates page of DEGIRO. So what you pay for ETFs in the core selection is just the handling fee of €1. But what's also important to mention are other potential costs, and actually the most important one is the currency handling. In other words, if you buy an ETF with the currency in dollars, you'll pay an additional 0.25% in currency costs on that amount. So it's really simple to keep those costs low. Buy ETFs with the currency in euros. And another smaller cost saving is that you pay 2.50 euros per exchange at DEGIRO. Let's say you buy an ETF within the core selection and you choose the ticker IBDA, which is a core ETF that will be discussed shortly. You can see that this is listed on the Amsterdam Stock Exchange. When you go to DEGIRO and search for this ticker, the IWDA, you'll see ICS Core World ETF, which is correct. It does say USD behind it, but you notice two big differences. The first is, here you see EN, which stands for Exchange Amsterdam, meaning the Amsterdam Stock Exchange. And you can also see the currency behind it, euro. The other one is a different ticker or the same ticker on another exchange with a different currency, namely dollars. So in this case, you want the one from the Amsterdam Stock Exchange, and this is very important in the core selection. You have the same ETF with the same tickers on other exchanges, and sometimes, by the way, also other types of tickers. So that's really confusing. So you really need to pay close attention to this ETF in this case. Does it fall within the core selection, yes or no? And for that, you need to choose the right exchange. If you choose a different exchange, then you not only pay currency costs in this case, but also higher commission fees. I'll give you the example. We're going to possibly buy this ETF or not. I'm just typing in some fictional amounts to show you. When you place an order, you'll see the estimator shows the DEGIRO fees are €1. That's because we've now chosen the right ticker and the correct exchange, and also a euro currency. Are we going to buy the other ticker? And again, we're actually doing the same little trick. Then we see that the estimated fees are €3, because we have €1 in handling fees plus €2 in commission fees. It's ICS World Core ETF, but it simply doesn't fall within the core selection because it's just a different exchange. Well, what you also don't see listed here are the currency costs. So you have commission fees, €2 plus €1 in handling fees, that's €3. But on this purchase amount, in this case $900, there's also 0.25% in currency costs deducted. So mistakes can be made quickly if you buy the wrong ETF and keep buying it for years, then you unexpectedly end up with very high costs. Well, you can also go to the DEGIRO website. If you go to ETF Core Selection, under rates, ETF Core Selection, you'll actually find a kind of handy tool that they use. You can keep the expense ratio low and, for example, choose a global region, and then you'll see a number of ETFs that have a relatively lower expense ratio, but I'll show you that you can do it easiest and fastest through DEGIRO itself when you're logged in.
Go to our website businessinvestors.info. You can find our own track record of money invested and our performance. And then go to free investing tools, where you can download a lot of free investing tools. For example, stock portfolio tools, stock calculators for intrinsic valuation, and also free investing ebooks, ETF investing guide, stock investing guide, and more coming soon.
When you log into DEGIRO, you want to look up a number of core selection ETFs. However, as I mentioned in the introduction, there is also a downside to the core selection ETFs. That is, they sometimes change, and they also tend to have higher costs. What does that mean? Here you can see the total expense ratio. You can look up that expense ratio for each fund. A fund isn't free, it's managed by a provider. In this case, for example, iShares or HSBC or VanEck, and those people want to make money, so they charge a certain fee. And the total expense ratio is basically just an annual fee for managing the fund. 0.2 means 0.2% per bull year. So if you've invested €1,000 in that fund, you pay 0.2% on that annually. It may not seem like much, but some ETFs are significantly cheaper than others. 0.05% is really cheap. For example, more expensive is 0.7%. And in the DEGIRO Core Selection, you'll find several ETFs that fall within the core selection but have a relatively higher expense ratio. But this is something you need to calculate yourself. There's a big difference in what's more advantageous. If you are investing very large amounts, you will want an ETF with the lowest possible expense ratio. You'll pay less tax or costs on the total amount. Larger amounts mean smaller impact from transaction costs. Generally, for larger investments, choose cheaper ETFs. How do you find those cheap ETFs? If you're dealing with really small amounts, then the transaction costs of €1 versus €3 have a bigger impact in terms of percentage, so you need to figure that out for yourself. But a simple rule of thumb is that if you're investing larger amounts, you want to go for cheaper ETFs. Now, how do you find those cheap ETFs? You log into DEGIRO, go to products, and then go to trackers ETFs. And here you can filter all sorts of things. And we're going to do that for the core selection in just a moment. But first, we want to find the potentially cheap ETFs. What we're going to do is we're going to look at the total expense ratio. That's under 0.5%. Anything above 0.5% is definitely expensive, but ideally you really want it to be cheap. And what you do is a handy little trick. You type in 0.01 and here you type 0.1%, or let's say 0.15%. That's still relatively cheap. And when you do this range, you'll see the abbreviation TERG here. TERG stands for total expense ratio. So here you can see what the costs are at DEGIRO to invest in this fund. And this is of course exclusive of those transaction costs. So that difference in transaction costs, whether or not it's in the core selection, and also whether it's in the euro currency, as you can see here, or some that might be in a different currency like GBX, or maybe in dollars. Here we find one with dollars. And you find the expense ratio here. And actually what you can do is take a look at which ETFs might be cheap, but they don't fall into the ETF core selection. Now in this video, to save time, we're going to go straight to the DEGIRO Core Selection. But I encourage you to compare certain ETFs with other alternatives that are very similar, which are also available for purchase through DEGIRO, but simply have a cheaper expense ratio. And well, I found that for some, but not for all. So that's obviously a limitation that you can easily solve yourself. Look, by finding more cheap ETFs, you can also easily find the core selection. Once again, you're going to log into DEGIRO and go to Products Trackers ETFs. You'll end up on this page, and here you can type in commission type that you want to see the ETF core selection, and you'll automatically get a list of the most up-to-date version of all the ETFs that fall within the core selection. In total, there are about 150 or 200. You can see the exchange and tell easily. The tickers and ETFs in this list are under the core selection. Filter for a lower expense ratio like 0.19%. And of course, you can also filter here for a lower expense ratio. It shows 0.9% as an example. As a result, some ETFs of 0.2%, for example, also fall outside, but you'll immediately find an overview of both cheap ETFs and those in the ETF core selection. However, just a reminder, don't focus too much on this core selection. And here you also see a number of cases of zero in between. What have I said? If you want to eliminate that zero because that does not give a correct picture, they may even be more expensive, but the data is simply not filled in. To correct that, you fill in the range from 0.01% to 0.19%, and then it automatically removes the ETFs with 0%, giving you the most up-to-date overview of very cheap ETFs. One of those is the Vanguard S&P 500 with the ticker VUSA. That is indeed on our list of the best ETFs for the core selection. However, I want to start with number one, which I really think is by far the best ETF for the long term within the core selection. And unfortunately, it has a somewhat higher expense ratio. And for that, we're going to the Invesco QQQ. There are multiple tickers, but basically they all fall under the ETF core selection. At least the Invesco EQQ Nasdaq with the ticker QQ on the EPA exchange as an example. We wanted to buy this ETF. That price of $4.50 doesn't mean much to us, but I want to show that the costs are indeed €1, and you're buying in euro currency, so you don't have any currency costs. And if you try to buy as much as possible on the same exchanges, EPA is for Paris in this case, but if you try to buy as much as possible on the same exchanges, you'll also save $250 for each extra exchange that you might not need. Now, the Invesco QQQ is by far one of the best ETFs. This is distributed, which stands for distribution, meaning that it pays out dividends. You also have ACC, which is behind the label. That means accumulation. And the accumulating ETFs automatically reinvest the dividend within the ETF. I'm a supporter of that myself. It saves on dividend tax in the short term, and you get more capital gains over the very long term. Now, I've shared detailed information about the Invesco QQQ in another analysis on our channel, Happy Investors, so check that out on our channel. Just simply search for Invesco QQQ and you'll find a detailed analysis on it. That's very relevant. Why? Although I believe this is one of the best ETFs for the long term, it has a higher volatile risk for the fund, especially for beginner investors who don't know what they're doing. And the reason for that is because it mainly focuses on 100 of the most innovative companies, which are often technology companies. An example, if you go to the website investingcoop.com and you go to holdings, you'll actually find an overview of the different holdings. If you have no idea what I'm talking about right now and you don't know what the top 10 holdings mean and you also don't know what these allocations here mean, then you need to take a step back and check out our basic videos on happy investors, both on the website and on our YouTube channel about how ETF investing actually works. Or you can take one of our courses on ETF investing, a relatively inexpensive course, and then we'll explain in a nutshell how that works. And of course, tips for advanced investors to achieve higher returns. Now here you see those holdings and you see a lot of well-known names, and the Invesco QQQ is known for investing in about 100 of the best technology or innovative companies. Yes, and then you see of course the big well-known names, and historically the fund has performed very well. Since 1999 plus 1000%, so your wealth multiplies by 11, and that's 400% more than the S&P 500. So that's obviously a phenomenal performance, and it all comes from these giants here that have become incredibly large. And what this ETF does is simply track these stocks. But in this case, you see the percentages, which means that these top 10 stocks here account for a total of 51% weighting of the entire fund. So all the other 90 or 91 companies in this fund make up the remaining 50%. So a large part, the results of this fund is achieved by these giants. And crucial, and this is more for advanced investors, is that the valuation of this ETF has really increased, but I'll explain that in the other analysis. We're not going to repeat it in this video. For the long term, QQQ is really strong. It's a solid fund because you're just tracking technology stocks. Historically, you just achieve higher profitability. To keep it simple, they make more profit than other types of companies. They can grow faster, scalable earning models. So for the very long term, that's super interesting. The ETF has really increased a lot. At Happy Investors, we also share a weekly update with buy and sell signals for ETFs. Of course, we also track the QQQ, but we also follow all the other ETFs from the core selection in our ETF alerts. For example, here with QQQ, you can see how volatile it can be. In 2021, it had dropped by about 30% up until even 2022, so that means your assets are just declining for a whole year. However, after both dips, it increased by almost 100%. But you also need to look at the long term, what's really happening. Of course, we all know about the dot-com crisis. At that time, it was actually the Nasdaq that had dropped by almost 80%, so a lot of tech stocks had plummeted. Well, today's situation is not comparable to the dot-com crisis, but companies like Apple, Microsoft, and Facebook all have super high valuations, partly justified because they are superior companies. But the market is really starting to rise now. It also has to do with Trump. Also, just the fact that there's so much money in the world and it has to go somewhere. So specifically for 2025 and specifically for this video, for the DEGIRO Core Selections, yes, I'm convinced that Invesco QQQ is one of the very best ETFs for the long term. Even for beginner investors, if you simply invest a certain amount every month, just keep in mind that this tracker, this fund, could drop very hard in 2025 or maybe 2026, and it could stay down for a long time. Think about a year or maybe even 2 years. And basically what you need to do is stick to the strategy of continuing to buy. So Invesco QQQ, very interesting, falls within the DEGIRO Core Selection. By the way, the website states that the expense ratio is 0.2%, but specifically for this fund at DEGIRO, there's a variant of that, and its expense ratio is 0.3%. Now let's take a look. The other interesting ETFs within the DEGIRO Core Selection.
Go to our website businessinvestors.info. You can find our own track record of money invested and our performance. And then go to free investing tools, where you can download a lot of free investing tools. For example, stock portfolio tools, stock calculators for intrinsic valuation, and also free investing ebooks, ETF investing guide, stock investing guide, and more coming soon.
When it comes to the potentially best global ETFs that also fall within our DEGIRO Core Selection, you actually have two choices. In other words, the ICS Core World ETF or the Vanguard All World ETF. The first one has the ticker IWDA, the other one has the ticker WWRL. Especially the Vanguard All World ETF is very well known, the ticker WWRL. However, personally, I prefer the IWDA. You can find them going to products, tickers, trackers, and then to ETF Core Selection within the commissioning type. By the way, mine is in English. I also make videos in English, and they are automatically translated with artificial intelligence to our international business account. YouTube account, so that's interesting, but that's not why we're here. We're here for the IWDA. Let's look it up in the list. And here, iShares Core World with the ticker IWDA. This is one of the best global ETFs. The stock exchange is Amsterdam. This price here isn't that much, but you can buy it for 100 euros. So basically, you could start with the Monday investment from 100 euros. In this case, 105 euros. Regional coverage and the total expense ratio is 0.2%. Now why? IWDA versus VWRL? It's very simple. We're here for the best ETFs from the DEGIRO Core Selection and the best overall. A long-term perspective means the highest achievable return depending on your risk profile. Well, first of all, both ETFs are global, have a lot of diversification, so the risk profile is lower. Earlier, we talked about Invesco QQQ, which has a much higher risk profile, tracking 100 companies, mainly in technology, 6% technology, and the rest in other sectors, but all innovative. But the ICS Core World ETF tracks 1,300 companies and does so globally. So, both more diversification in stocks and also regional diversification. And the difference in choosing between the iShares world and the Vanguard world is simply the return. Over the past 5 years, it achieved a 90% return, while the VWRL ETF achieved a 56% return. There is still a small difference, and that's also why I'm specifically in favor of the IWDA. The IWDA is accumulating. Here, if you see ACC behind the name of the ETF, that means accumulating or accumulation, and it means that the dividends paid out by those companies are automatically reinvested in the fund. That way, you create more compound interest effect. Meanwhile, the Vanguard ETF is distributed. Here you also see DIS, or sometimes it says DIST, so DIST with a T, and that stands for distributed, which means they pay out dividends. So, then you'll see in your portfolio that you receive some dividends from time to time, but the dividend is low, plus you also have to pay dividend tax on it. But if you just keep reinvesting it continuously, you get a compound interest effect. And if you're a long-term investor, that's definitely what you want to see. 90% versus 65% is really a pretty big difference. And not only that, the ICS Core World ETF with the ticker IBDA is also part of the Core Selection and is a bit cheaper, but with an emphasis on being a bit cheaper. The expense ratio is 0.2%, while the expense ratio of the Vanguard All World is 0.22%. Looking at the number of positions, the IBDA tracks 1,400 companies, partly worldwide, but mainly focused on America. With the Vanguard, it's exactly the same. They also track countless companies, something like 3,600 off the top of my head. We see it here, 3,650, and also mostly in America. I think that's a very important part, because that's a very important part. Isn't that risky? No, not at all. Statistically speaking, you already have enough risk diversification if you have a portfolio of, for example, 25 stocks spread across various sectors. So 1,400 stocks also spread across the world. And that's also one of the reasons why I make these videos. It doesn't really have much to do with spreading risk. So here we could actually say that the Vanguard ETF with more than 3,000 stocks has too much diversification. That might also explain why they have a low return. They have a lower return, and just with more than 3,000 stocks, it has the plan. That's a term, diversification, in English, diversification. Just look up diversification on the internet with a W. In other words, the deterioration of returns due to too much diversification. Yes, that all exists. You can spread risks too much, which means you'll get lower returns in the long run. But as a passive beginner investor, a global ETF is just a really good choice. You don't have to lose sleep over it. There are definitely a few important things you need to know. Just like the QQQ, which is highly valued, the IWDA also has a PE ratio of 25. Historically, 15 is the median, so anything above 20 is actually considered expensive historically. There are some great companies in there that historically haven't been that great. I should mention a lot of much stronger companies that have brilliant earning models, but still a PE ratio that exceeds 25 for a global ETF. That's where my concern starts to come in, at least for me. However, we're not here for in-depth analyses of ETFs, but more for a global overview of what the potentially best ETFs for Nigeria are in the long term, which also fall within the core selection. On the website itself, you'll find all sorts of information about the stocks, in this case, the top 10. And here, you can see the weighting. You also see much more diversification compared to other thematic ETFs. And yes, you can actually see what kind of stocks there are. Also categories like IT, finance, that sort of thing. And you'll also find geographical diversification somewhere on the website. It's the same with Vanguard. Actually, the only advantage of Vanguard right now compared to the IWDA is that the PE ratio is 21, so it's a bit lower. Not much lower, but it's a bit lower than the IWDA with a PE of 25. You can see the geographical diversification here, so a large part is in the United States, 60%, and actually the well-known names that are in there, Apple, Nvidia, Microsoft, Alphabet, Those are all the well-known names that obviously make up the largest positions in those funds. Purely objectively speaking, IWDA just achieves higher returns than VWRL. It all looks amazing over 5 years, 90%. That's almost a doubling of your wealth in 5 years. Well, really keep in mind that, as I just said, the valuation has risen so much that a correction is just very realistic. And it could very well be that for a long time an ETF delivers almost no returns. Unfortunately, the IWDA only goes back to 2009. So that's just after the financial crisis. But with a lot of ETFs that have a longer history, you'll see that the price level between 2000 and let's say 2002, just after the dot-com crisis, up to the 2008 financial crisis, barely realized any returns. Then there was a significant drop, so that was somewhere around here, and then slowly recovering, and actually only starting to realize returns from around 2012. If you had invested 10 years ago at that moment, you would have had no returns for 10 years. And with the higher valuation that keeps rising, that could very well be a scenario for the IWDA. How do you deal with that? Simply buy the dip. Keep buying more whenever these types of ETFs drop. The IWDA offers a lot of diversification, but even then, if you look at the short term, you still see regular dips of 15%. During the Corona crisis, it was down 30%, minus 30% in a short time. In 2018, there were also some overvalued stocks, down 12%, and in 2023, especially growth stocks that were overvalued percentage, and in 2023, especially growth stocks that were overvalued. Yeah, about a 15% drop. So you see, a 15% drop is already quite a lot. If an ETF like the IWDA drops by 30%, then that's the moment to really invest a lot of money, but only money that you can truly afford to miss for the long term. And the very long term means more than 10 years. Why would you do that? Well, simply for the returns. Let's say you invested in 2010. This is really a best case scenario because the past few years have just been incredibly good for the stock market. A year later, you would have achieved a return of almost 500%. 500% means your wealth multiplied by 6. If you had invested 100,000 euros in 2010, you would have almost 600,000 in 2024. Of course, you still have to account for inflation. 500% means your wealth multiplied by 6. So if you had invested $100,000 in 2010, you would have nearly $600,000 in 2024. Of course, you still have to account for inflation. Well, let's say you buy an apartment in 2010 for 200,000 euros. The chance that it would be worth 1.2 million 14 years later in 2024 is, in my opinion, very small. You do have leverage and other factors, but that's if you're a more advanced real estate investor. The chance that it would be worth 1.2 million in 2024, 14 years later, is, in my opinion, very small. You still have leverage and, of course, other things, but that's if you're a more advanced real estate investor. But simply put, stocks historically have the highest returns versus gold, bonds, and even laundry. Only we're talking about, in this case, global stock ETFs, even a global laundry ETF, that sort of thing. Only higher risk assets might come into play to achieve higher returns. And for example, the Invesco QQQ, which we mentioned first in this video about the best core selections, has achieved an even higher return, namely over 1000% and I think 80% in the same time frame. So there's always someone above you. Number 3 on this list of the best core selection ETFs at DEGIRO is the Small Cap World ETF with the ticker IUSN. Let's look it up. We have commission type ETF core selection enabled, and we're going to the ticker IUSN, and here we see the ICS World Small Cap ETF, and that's a very important point, and that's also one of the reasons why I'm making these videos. The expense ratio is 0.35, and you can see that the diversification is global. Now, you can actually compare this World Small Cap ETF with, for example, the IDA or the VWRL, right? Those are also global ETFs, but the difference is that those global ETFs focus on large cap stocks, while the iShares World Small Cap focuses on small cap stocks. The difference is large cap versus small cap. That's a term in investing. Large cap refers to companies with a market value of over 10 billion. Small cap, the definition of that, are companies with a market value of 200 million up to 2 billion. So that's quite a difference because small cap stocks are smaller companies. Smaller companies are riskier because they can either grow faster or decline faster. And yes, simply by buying an ETF, you're actually investing in this case, more than 3,000 small cap stocks spread all over the world. About 60% is from America and 40% is from other worlds, so Europe and Asia. And the ICS World Small Cap ETF tracks about 3,000 or 3,500 small cap stocks. It varies a bit over time. it's accumulating, so it reinvests the dividend and doesn't pay out any dividends. And you can see that there can be longer time periods, in this case from mid-2021 to mid-2024, so 3 years where no returns are realized at all. And from time to time, you might actually be in the negative for 2.5 years. So here you can see great opportunities to just keep buying in consistently at a low price. It's a global ETF, so a 10% drop in the short term is already significant. A drop of 15% becomes attractive, and a drop of more than 30%, like during the coronavirus crisis. Those are the moments when you just want to invest a lot of money and not look back for 10 years. So that's the ICS World Small Cap ETF. How do you deal with this? I also explained that in another video about the best ETFs. For global investors or passive investors or beginner investors, what you can do is combine the iShares World Small Cap ETF with, for example, a large cap world ETF like the Vanguard All World with the ticker VWRL, or, and this is my preference, the iShares Core World ETF with the ticker IWDA. By the way, whether it's iShares, Vanguard, Invesco, or Amundi, it doesn't really matter. That's just the publisher. What's more important is what the diversification of those ETFs is, what their historical performance is. Anyway, just because they've risen a lot in the past, I don't want to say that they're going to rise a lot in the future. You really need to look at how stable an ETF is and whether that fits your risk profile. Some ETFs fluctuate a lot. That might not be suitable for you if you're looking for stability. Other funds are very stable but generate a relatively lower return. So here it comes back to the risk and return profile. Simply by combining the ICS World Small Cap ETF with a World Large Cap ETF, you actually have diversification across a lot of different stocks, both small and large, all around the world. And that's it. Then you're all set with 2 ETFs for passive and low-cost investing, simply with a lump sum or a periodic investment. But do you want higher returns? Then you'll need to look more at thematic ETFs like the Invesco, QQQ, or other thematic ETFs that will be discussed in this video. Number 4 as the best ETF in the DEGIRO Core Selection is of course the S&P 500 ETF, one of the strongest trackers in the world. I made another video specifically about the S&P 500 for the coming year, where the S&P 500 does have a very high valuation. That's a very important point, and that's also one of the reasons why I make these videos. A new term, if a correction is on the way, then it would definitely be worth considering changing your strategy. And you can actually choose between a global ETF or just the S&P 500 ETF. But of course, you need to know what you're doing. Now, within the core selection, you'll find a number of S&P 500 ETFs, and basically, it doesn't really matter which one you choose. However, we definitely want to look for the cheapest one. Well, one of them is the Vanguard S&P 500 ETF with the ticker VUSA. You also have another fund, which is from Amundi, S&P 500, which has a cost ratio of 0.05%, so that is even a little cheaper. But yes, the difference is so marginally small that in principle it doesn't really matter. And that one doesn't fall within the core selection, while the Vanguard S&P 500 does fall within the core selection. For more information on how to invest in the S&P 500, check out our YouTube channel or our website. Just type in SP500 and you'll find specific videos that can help you with that. And actually, in line with this, we're going to invest in the US market with the S&P 500. Now imagine, you're a somewhat advanced investor and you believe that, well, the entire US market is really overheated. I actually believe more in the European market. What you can do, for example, is to buy just an ETF that focuses on Europe, or include it as part of your ETF portfolio. For that, we need to look for stocks. And then we find one interesting ETF within the DEGIRO Core Selection, which is the Amundi Stocks Europe 600. Number 5 is the Amundi Stocks Europe 600. You also have other stocks ETFs that, for example, focus on 650, so those are actually 50 European companies. Well, the difference is that the Stocks 600 focuses on 600 European companies, so it actually offers relatively more diversification. This ETF might not be the absolute best in terms of returns, but it's suitable for beginner investors who want to spread their risk within Europe. I wouldn't choose that, because America, the United States, is more interesting for long-term investing due to its culture and money, especially with the win-and-take-all mentality and innovation culture like Silicon Valley, achieving higher returns. However, when the S&P 500's valuation is high, like today, and the Stocks Europe 600 is more reasonable, it offers lower risk. If the S&P 500 corrects, the Amundi Stocks Europe 600 might drop less severely. So, it might still decline as capital exits the market due to anxiety. And if the S&P 500 corrects, the Amundi Stocks Europe 600, for example, may fall less sharply. So it might drop as well because capital is leaving the market as people get anxious. But since it's relatively cheaper, it shouldn't have to drop as much, because if it drops the same amount, then it becomes a real bargain. That's basically the difference. But since it's relatively cheaper, it shouldn't have to drop as much, because if it drops the same amount, then it becomes a real bargain. That's basically the difference. The Amundi Stocks Europe 600 has the ticker MUD, and you can see here that the expense ratio is just 0.07%. So this is also a cheap ETF. And actually, I think it's more for investors who want to rotate. What's the Dutch word? Want to rebalance, where you sometimes reduce your exposure from US markets to, for example, European markets, because you're convinced that those valuations are cheaper, and that way you're lowering your risk.
Go to our website businessinvestors.info. You can find our own track record of money invested and our performance. And then go to free investing tools, where you can download a lot of free investing tools. For example, stock portfolio tools, stock calculators for intrinsic valuation, and also free investing ebooks, ETF investing guide, stock investing guide, and more coming soon.
An interesting thematic ETF for the long term that is also available in the DEGIRO Core Selection is sustainable energy. A thematic ETF is riskier because it focuses on one theme, and we will see in this video that it has its pros and cons. First of all, if you search within the DEGIRO Core Selection, you'll find a whole list, and you can simply search using the search bar within the DEGIRO Core Selection. We actually have two ETFs for sustainable energy. The first one is the Invesco Global Clean Energy, as an example. Within the DEGIRO Core Selection, you have two ETFs that can provide you with exposure to that. The first is Invesco Global Clean Energy, and the second is iShares Global Clean Energy. Basically, there are a few differences, and we're going to talk about that. Here you can also see which ticker applies within the core selection. There's a small difference in costs, but more importantly, there's a big difference in the number of positions, and especially in the distribution of those positions. Let's start with the iShares Global Clean Energy. Personally, I would prefer that one. And there are different tickers, but as you can see for the DEGIRO Core Selection, there is a ticker IQQH. Now, the total costs per year are significantly higher than, for example, a global ETF, namely 0.65%. And for the Invesco Global Clean Energy, it's 0.6%. So, actually, it's similar. So I think it's good to say that 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 it's good. The iShares Global Clean Energy has positions in about 100 companies. And actually, the reason why this ETF can be interesting now for 2025 and also 2026 is start building positions right now. Why? Because the PE ratio is currently 13. And for example, the S&P 500 PE ratio is above 25. That PE ratio is a valuation. If you don't know what that means, check out our other videos on getting started with investing. But it means that stocks under 15 are relatively cheaper. Of course, there are some caveats to this rule of thumb. Now, such an ETF can drop a lot. Since the all-time high in 2021, it has dropped by more than 62% to this day. And don't think that this is the ultimate buy the dip moment, because the price level is actually comparable to 2020 and also around 2015. But you can see, for example, that this ETF was already on the market in 2011, and actually, from that price level in 2011, it has dropped another 40%. And it has also dropped by about 30%, actually, about 7 years later. So 7 years later, it would still be down 30%. So the right moment to get in, nobody knows that. But I think it's better to build positions when valuations are low rather than when they're high. So when a new hype comes along, you can take advantage of it by selling high and then buying back in low. But no one knows exactly when is the right moment to start buying back in. So monthly deposits would be relevant and very important for that very long-term holding. Because markets just move in cyclical patterns. And in this case, solar energy, wind energy, and other renewable energy companies have been hit really hard. And actually, nowadays there's an additional significant factor, and that's Trump. That will not be favorable for renewable energy, especially for America. You see the portfolio ratio, and we'll take a closer look at that in a bit. But what's also important is the ratio across the number of sectors. And here you can see that 60% of global clean energy is invested in utility companies, a bit in industry, and not much in, for example, IT or others. Now, the geographical distribution is a small part in the United States, 25% and 12% in China. China is also a market that has dropped a lot lately, but other countries like Brazil, which is obviously a less stable country, and various companies from European countries as well. Now, the Invesco Global Clean Energy looks very similar to the ICS Global Clean Energy in many ways. So it's a bit cheaper at 0.6% per year, although that's not a huge difference. But what's more important is that the number of holdings is different. First of all, the distribution across sectors is a bit different, but not shockingly so. The country exposure is indeed different, with more in the United States. For the Invesco Global Clean Energy, now that Trump has taken office for the next 4 years, I think you actually want to have fewer positions in renewable energy in the United States. So that's also an advantage for the ICA's Global Clean Energy. But of course, you have to look beyond Trump, because this is about long-term investing. What's important, however, is the difference in strategy, and we can see that reflected in the top 10 holdings. We can find a clear overview through another source. Here we see the top 10 holdings of the ICS Global Clean Energy, and you can see that certain positions are assigned larger percentages with the total. Being about 50% of the top 10, that's quite a lot. And that's also one of the reasons why I'm talking about this company. Potential and gets 8% in this ETF. That's relatively a lot. Other companies like Iberdrola also get a relatively high percentage. While with the Invesco Global Clean Energy, we see a different strategy. That's a different strategy, UX strategy. And ASPSJAR, where actually all the holdings get a maximum of 2%, but most are around 1% or even less than that. And you also see that the top 10 holdings only represent 11% or 12% weighting over the total. Now, what we're seeing with theme ETFs from mid-11 years of investing is actually that the more concentrated ETFs have the potential to outperform. That's because you actually want to have as much capital as possible in the best performing stocks. But no one really knows for sure which ones those are, and the ICS Global Clean Energy actually just lets the winners run more, and that could pay off better in the long run. But anyway, both funds have dropped a lot. And the most important thing is that although the Invesco Global Clean Energy doesn't show this on their website, we see a price to earnings ratio of around 13 for the ICS Global Clean Energy. And it will only get cheaper as the fund continues to drop. In terms of relevant, very long-term thematic ETFs, the ICGC, which falls within the core selection, is a possible option. But again, don't be blind to it, because this thematic ETF is purely within the core selection. There are, of course, other interesting thematic ETFs as well, so let's talk about those too. An interesting thematic ETF that has dropped significantly with acceptable valuations and potential for long-term growth, but also a lot of uncertainty, is the Chinese Internet ETF with the ticker QEB, which is the Crane Shares China Internet ETF. By the way, this is a somewhat more expensive ETF with an expense ratio of 0.75%, and that has now been slightly lowered, maybe 0.7%, depending on the other broker. There's not a lot of relevant information to be found on the website itself, but of course they do provide the necessary information that they need to. Now, in the short term, leading up to 2025, this ETF seems to be gaining some stronger momentum. Don't forget, even if you think you're investing in a fund, the losses can be disastrous. Namely, it dropped by at least 80% from the all-time high in 2021 to 2022. And even today, the fund is still down 67%. When should you buy? When there's fear and panic. And when should you sell? When there's a hype. So it's better to buy low and sell high. But in practice, it's really difficult. By the way, it's still possible that the fund could drop even further. And it could also be the case that, as you can see in the long term, there might be almost no price development, like here between 2014 and 2016. But actually, if you had bought in 2014 and now you're in 2024 or early 2025, you could still be at a loss. So it's not always easy to say that every thematic ETF is profitable. There are times when it can be very profitable, and there are times when it can actually be unprofitable, even in the long term. So be careful with what you do. Personally, I find the Crane Shares China Internet ETF quite interesting, and the reason is that it contains some really strong companies. If we take a look at the holdings, you'll see a sector breakdown across different sectors and the top 10 holdings, which you can also find on the website. You go to the Crane Shares website and you find the ticker QEP, then you go to holdings and here you find the top 10. And if you download the full holdings, you'll find an overview like this one, where you can also see other smaller holdings. Some names mean nothing to me. Maybe more importantly, the top 10 includes well-known names like Tencent, which has a really strong moat. But you can say the same about others, like Alibaba, of course, and for example, JD.com is definitely a very interesting stock. You could even consider buying JD.com as an individual stock, but that's for advanced investors. Trip.com has been doing really well lately, but more importantly, the total holdings are just 33 Chinese internet companies, also all from China. So you have geographical risk from a country that is quite uncertain, especially now that the United States, with Trump, might make some crazy moves. And another thing is that the top 10 holdings make up 62% of the total fund, so that's not really very good. Moreover, in terms of rating at the moment, the Crane Shares Internet ETF is getting a strong sell based on a database that compares this ETF with more than 2,000 other ETFs, and momentum is a very important factor. You also see that the costs get a D+. That's not good, because this fund has higher costs. It's more expensive. No dividend or almost no dividend. It's also risky because it's very volatile. That's why it gets an... Only liquidity is actually positive at the moment and will likely remain positive in the future. But momentum is a very important factor. In this data model, and yes, you see the 5-year return of the ETF is minus 26%, so that's just super bad. You can also see that the median of all ETFs has had a positive return over the past 5 years, while the Chinese Internet ETF has dropped 26%, and also in the short term, it's not doing very well. But during the dip, it can sometimes come in handy. Of course, even though China has announced a huge government stimulus, it's still a market that's hard to read. So, it remains risky. The result can also be significantly disappointing in the long term. A lot of core selection can be interesting for long-term investors, but what you really want to do is anyway. Buy when the fund is very low and sell when the fund is at a significantly higher level. So pay close attention. This is not just a passive long-term investment, because you see the results can also be significantly disappointing in the long term. Buy when the fund is very low and sell when it finds itself at a significantly higher level. Nevertheless, it's interesting, maybe for the more advanced investors, when we talk about the potentially best ETFs for the long term, and also thematic ETFs, we can't forget the theme of semiconductors. Semiconductors are really interesting for the long term, and specifically within the DEGIRO Core Selection, there are a total of 2 ETFs focused on semiconductors. The first one is the ICS Global Semiconductor ETF with the ticker SAMI. We find the second one by going to the second page, and there we see the VanEck Semiconductor ETF with the ticker VVSM. That's a very important part of the economy, and that's also an important part of the economy. Choosing a semiconductor ETF alone, there's a big crucial difference, and that is risk diversification. The iShares Global Semiconductor ETF, as the name suggests, is global, but it's focused on more diversification and has more positions. About 200, and we see here that the number of positions is 260, while the VanEck Semiconductor ETF only has 25, so that one is very concentrated. And that's really quite striking. The costs are actually comparable, both at 0.35%, so that's not a reason to choose one over the other. What's interesting is that although in a downward market, like in 2021 for example, until the drop here somewhere in 2022, the iShares Global Clean Energy performed with a decline of about 43%, or let's say 40%. Meanwhile, the recovery from that same moment up to today is around 26%. What's interesting is that if you look at the VanEck Semiconductor ETF during that same time frame, it also dropped by about 43 to 40%. However, during the recovery going upwards, the return is significantly higher at 63%. So here we see a typical example of diversification. In other words, having too many stocks, in this case the IHS Global Semiconductor, with a lot of losers in it, is not favorable, while the VanEck Semiconductor, with only 25 holdings, performs significantly better. Koenig has chosen the best winners in her thematic ETF from VanEck, and this is really crucial. The best winners from the past few years don't necessarily have to be the best winners for the coming years. Yeah, I don't really know exactly which ones those will be either, so that's very important for the success story of VanEck Semiconductor. The ETF with the ticker SMH, that's the international ticker, or in the DEGIRO Core Selection, the ticker VVSM to save on transaction costs. Now, a big difference besides the positions is of course the top 10 ratio. The SMH, the semiconductor from VanEck, is very concentrated. But what's important is that in both cases, the PE ratio is super high. The iShares Global Semiconductor ETF has a PE ratio, a ratio above 30. Historically, that's just really high. And you can say, yes, it's a super relevant thematic ETF, and it really is. However, the semiconductor ETF always moves in cyclical patterns. Always. And the higher the PE, the greater the chance of downward declines. And it won't be the first time that the fund, in this case, could drop with a correction of 30 or 40% or more. So pay close attention to when you should get in. Then we have the VanEck Semiconductor ETF. The official ticker is SMH. So within the DEGIRO Core Selection, there's a different ticker. So keep an eye on that. Costs are 0.35% per year. And if we look at the number of holdings, we see that there are 25 in total. And the top 10 holdings make up a total of 75%. So that's really high. So this theme is very concentrated. And of course, the winner is NVIDIA. Yes, it has performed amazingly. Broadcom has also performed really well. In our individual analysis, we selected Broadcom in 2022. It's at something like over 200%. Check out our website for that. Those analyses are available for just €99 a year. So not a whole lot. And you see other companies that are doing really well. For example, Taiwan Semiconductor could still have a realistic entry point today because the PE ratio of Taiwan Semiconductor is quite reasonable. The one from NVIDIA, for example, is really high. So the downside risk simply increases because of that. So be careful about when you enter. And I'm not really sure if I sold something in my portfolio here at the beginning of 2024. You see, I don't remember exactly when it was. I sold in phases. Is this a beginning? 24? You see, I don't remember exactly when it was. I sold in phases. If I had held on, it would have gone up a little bit more, and maybe it will go up even further in the future. Who knows? I gradually sold my larger positions in this ETF for profits and reinvested those profits into other ETFs, mainly focusing on stocks with much lower valuations. Time will tell what the best strategy is, whether it's buy and hold or trying to sell high and buy low. And that will be my focus as well with the semiconductor ETF. If this were to experience a significant drop, a big correction, I wouldn't hesitate to buy a lot of it. Because it's just a great thematic ETF, super relevant for the future. But today, specifically nowadays, the valuation is just super high. So pay close attention to that. Now, if we take a look at the rating in our data model, we see that it has a buy rating. That's compared to all the other ETFs in the data model. And actually, the main reason is that the momentum is still very strong. Look, the 5-year total return of this ETF is 300%. So in 5 years, your wealth has quadrupled. If you had invested €10,000, that would be 4 times, which means €40,000. But like I said, it has risen so quickly all day that the chance of further increases is simply less likely. But it never says never. But determining the right moment is very important. It's a crucial weighting in this factor model, which is why it still gets a buy signal. So really pay attention to the risk. You see that it's called factor D, higher volatility, much higher than the average and even the median ETF. You also see the annualized volatility is 34%. I already mentioned it. The semiconductor industry moves in cycles, and NVIDIA is doing great right now. But when valuations are sky high, the same goes for all these other companies. When orders are a bit lower during a less favorable economic time, high valuation will be heavily punished with a correction. So time will tell, but only for the very long term. The next semiconductor ETF within the core selection of the DEGIRO looks really interesting to buy. And actually, to avoid market timing, you could choose to just buy every time there's a short-term drop of about 10%. And every time it drops further, then you basically get lucky and can buy more at lower prices. If you get lucky and it keeps rising from now on, at least you've already taken some initial positions. I doubt that it will rise a lot, but time will tell.
Go to our website businessinvestors.info. You can find our own track record of money invested and our performance. And then go to free investing tools where you can download a lot of free investing tools. For example, stock portfolio tools, stock calculators for intrinsic valuation, and also free investing ebooks, ETF investing guide, stock investing guide, and more coming soon.
A very interesting long-term theme ETF for a relevant growth sector is, of course, the cloud computing sector. And specifically within the DEGIRO Core Selection, we find one so we can buy it with lower transaction costs because of the core selection. And if we go to page 2 of the core selection, we find it here at the bottom with the ticker WTEJ, and it's the Wisdom Tree Cloud Computing. Now the official international ticker is WCLD, and we'll continue with that. You can see that the expense ratio through DEGIRO is 0.4% per year. That doesn't make the fund super cheap, but it's not overly expensive either. And the Wisdom Cloud Computing ETF obviously focuses on cloud computing. It has a number of very interesting holdings. I also have a few in my personal portfolio. First, let me say something about the breakdown. What I find interesting about this thematic ETF is that they have invested a relatively large portion in smaller companies, so a market value of less than 10 billion and even 10% also in small cap shares. These types of companies have higher risk, but if you buy a bundle, they can grow higher and faster with the weighted average and therefore achieve more price potential. The only downside is that the price earnings of this ETF is actually always a bit negative, so it mainly invests in riskier, unprofitable companies, but they obviously need to become profitable in the future. That's really the whole point of these companies, and that estimated PE ratio is therefore quite high at 38. That can also be low, but it depends on the long-term growth. In general, of course, it is the case that those PI ratio can be cheap if the companies keep growing, but that's the whole point. It's not certain whether they will keep growing, so the higher the valuation, the riskier it is. Also, a price to sales of 6. For a weighted average, it's not exactly cheap. A price to cash flow of 34 isn't exactly cheap either, but of course there's good potential, and that's the only reason you'd want to invest. Really keep in mind that from time to time this ETF can become very overvalued. The reason for existence hasn't been very long, since 2019, and actually in a very short time, because of that massive overvaluation and good stocks, the ETF has risen a lot, namely by 160%, but in just a shorter time it also dropped by 60%. For a long time it moved horizontally, and now, actually at the beginning of 2025, the fund is starting to move upward again. Just keep in mind, the valuation is really rising sharply right now. And yes, it's really a bit of guesswork, but for the long term, the best strategy for the Wisdom Tree Cloud Computing is definitely to always buy the dip and then sell high. So drops of 20% happen relatively often, and it could very well be at this current price level of 40% that the fund drops further. Let's take a closer look at this ATX exchange traded fund. The holdings breaking down is completely focused on technology, 100%. So we've talked before on our channel about popular tech funds like the QQQ, which I think is better, but the WCLD can really achieve interesting returns in the short term with its ups and downs. In that top 10 holdings, you see an even distribution. That's actually quite interesting. The strategy they use provides diversification. On the other hand, I would personally like to see them really let those holdings that are performing well rise above 2%, and now they're actually taking profits from companies that are performing well, like Bill Holdings, which has recently risen a lot. By the way, a very interesting mid-cap company. It's been unprofitable for a long time, but the CEO, who is also the founder, has a lot of insider ownership. Bill.com has a really interesting business model, so definitely take a look at that. We also covered Twilio, which I had in my own portfolio for a long time. However, I sold Twilio for a profit, and around 70% profit in 11 months isn't bad, but maybe I should have held on. Time will tell. I sold my profit, reduced my position, and reinvested in what I think is a cheaper company with at least as strong a moat and a bit more certainty. Also, other interesting ones like QT Holdings, definitely take a look at that. I also have shares in Shopify, actually for the long term. Interesting companies, good companies, all focused on growth from time to time. So they will show strong cyclical movements, and actually short-term drops of 20% or more happen relatively often. Right now, the ETF is getting a buy rating within the data model that we often use in our ETF analyses. Subscribe to our channel. We regularly make analyses like this, and these are also tools that you don't have access to yourself, but we pay for them, so you can also take a look for free this way. Why is it getting the buy rating? Mainly because the momentum is relatively strong. However, the 5-year total return is not very good at 60%, although above the median. But if you look at the top performing ETFs, including some that we've covered before on our channel, you'll see that 300% or 200% is much higher than 60%. Percentage that it is, much higher than 60%. Of course, this year it is doing well, and in the short term, as we just saw, the ETF is experiencing strong upward momentum. Personally, it would be more interesting if it starts to drop again, and then you can nicely apply the buy the dip strategy. Overall, for the long term, build positions and don't forget to take profits. Why? Also because the risk is simply a bit higher. Risk basically means the chance of total loss of money. I think that's a bit smaller with an ETF. Risk is also sometimes expressed in volatility. I don't agree with it myself, but that's just the world of investing, however they do it. And the standard deviation is higher. The volatility is also a lot higher than other ETFs. But of course, there are also global ETFs in this data pool. It does get a better score because it applies diversification by allocating a smaller percentage to the top 10 holdings. We've just talked about that. What I actually don't like about this fund strategy is that the turnover rate is really high at 30%. That means they actually change a third of the stocks every year. What I would prefer to see, as I mentioned earlier, is to just let the winners in your portfolio run. And 2%, I get it. In terms of trimming and diversification, especially with this strategy of cloud companies that can grow very quickly. Potentially there will be one winner out of 20, and it's those winners that you should let grow so you can achieve a much higher, stronger result. But they don't do that. It's a personal choice. That's up to them. Although, in the long term, I really find it an interesting thematic ETF. Definitely hold on tight, because the ride can be quite volatile. So this is not suitable for those looking for low risks or stability in their portfolio. If you have any questions, tell me. I'll help you, and thanks for watching. Finally, there are 2 ETFs within the DEGIRO Core Selection that you could buy if you want to invest in commodities, namely gold and perhaps even oil and gas. You'd want to do that because those valuations are still relatively lower. But let's take a look at gold. Historically, gold has been a less attractive investment compared to stocks. Stocks achieve about a 76% return per year over a very long term, adjusted for inflation. So with inflation, that's about 9 to 10%. And gold achieves a lower return than that. Let's say around 6% or 7% historically, depending on the time periods. At DEGIRO, you'll find several options within the core selection. First up, you have the ICS gold producers. And if you go to page 2 within the core selection, you'll find the VanEck Gold Miners ETF and also the VanEck Junior Gold Miners ETF. Well, in terms of costs, they're all around 0.55%. So that's not a reason. Choose one over the other. And there isn't really a big difference between the ICS Gold Producers ETF and the VanEck Gold Miners ETF. So here we see an overview of the ICS Gold Producers ETF, and you can see the top 10 holdings, more well-known names, Belkin Gold, the Newmont, and actually we find the same ones in the Gold Miners ETF. So let's take this further. I have no relationships with VanEck, nor with iShares or other issuers. So when it comes to names, I don't really care. But VanEck is just an example of the Gold Miners ETF, and there are 60 holdings in this, so 60 different companies that the tracker follows. And you can see that the top 10 holdings make up 61% of the total weight, so that's relatively high. Yeah, and here you actually see the same types of names coming back with the largest positions in Newmont, and also Agnico, Eagle Mines, and Berggold as examples to mention. And you might have a higher risk, because gold is of course a commodity, however you look at it, and it goes through cyclical movements. Junior Gold Miners ETF, so relatively smaller gold miners ETFs or gold mines, they should potentially benefit more from that. The gold price has actually risen quite a bit, but the shares of gold miners haven't really followed suit. So here there might be an opportunity for the right short term. The number of positions in the Junior Gold Miners ETF is higher, namely 80. The costs are also 0.55%, and you can see a bit more diversification here, where the top 10 accounts for 41% of the total instead of 60%. And you see other types of names, smaller mining companies. You can see some differences. Now you think that in the short term, namely 2021, there was a sort of all-time high. And you see, if you believe in something like technical analysis, which I don't really do much, but yeah, there's something like a self-fulfilling prophecy. But you see that there was a peak here in 2020, and that peak hasn't been broken recently in 2024. So yeah, often you have traders who anticipate that and sell and possibly buy again if there's another rise. Well, what's interesting now is if that imaginary line actually breaks through what they call a sort of resistance line. And why? Because first of all, taking a step back, the downside potential from this level is still huge. Even after a drop, it can still fall by 63% to the level of 2015, or maybe even further than that. But the upside potential is also quite significant because there was a peak in 2011. And actually nowadays it's still down by 40%. That's the really tricky part with these kinds of ETFs in commodities. No idea if gold is going to increase in the very long term. There are other ways to invest in gold, maybe even better than, for example, gold mining. Companies, honestly, this isn't my expertise when it comes to the sector, so be careful with that yourself. However, it could very well be that because gold prices have risen a lot, and actually the stock prices of gold miners are lagging behind, they might continue to rise. And by the way, you also have a completely different, more trendy alternative, namely Bitcoin. By the way, I don't do anything with that anymore. I used to do it for a long time, but in the last few years. Well, finally, if we're talking about commodity investing, within the DEGIRO Core Selection, there's the ICS Oil and Gas Exploration and Production ETF. Then you think, oil and gas, what are you talking about? However, it could very well be that oil and gas are still really needed, in at least the short and medium term. And if more oil and gas are needed than expected, for example, just the thesis that renewable energy is lagging behind, which is actually becoming an even more plausible thesis now that Trump is in power, and renewable energy is already falling behind in terms of energy. It could very well be that more oil and gas are needed, and that means prices will rise, which means that the valuations of companies will drop because those companies will be making more profit. And that valuation is already relatively okay, historically speaking. The PI ratio is around 10, which is pretty much the historical average for these kinds of community companies. This ETF tracks a total of 66, so let's say around the price to book ratio is just above 1, and the PI ratio isn't exceptionally high, while, for example, the S&P 500 or what we have, technology ETFs, they have a PI ratio of over 25 or even over 30. So yes, if you are talking about investing a bit in cheaper stocks in an ETF, then this might be an option. And of course, you would want to do this if you have advanced knowledge of this market, oil and gas. Top 10 holdings, you can see it here in the overview. A number of more well-known companies, and a few that might be a bit less known. And through the DEGIRO Core Selection, as you may know, it's available under the ticker, which is currently being used in the market for trading. We need to look it up. The ticker IS0D. If you look at the short term, we see that it has been moving horizontally in terms of price since actually 2022. And yes, a major overhaul after the corona crisis. Zooming out, the price might fall. Look ahead, as investors do. Expect top 10 holdings and other companies to profit more in the future based on supply, demand, and production optimization. Download the full overview on the iShares website. And if you expect that these companies in the top 10 holdings, as well as other companies, you can download the complete overview on the iShares website. If those companies are going to make more profit in the future, and that's going to happen based on supply and demand and a bit of production optimization, if that's the case, then this is quite an attractive ETF right now because the current valuation isn't super high. But is it a great long-term investment? I don't know. We'll see. Do you have questions about the best ETFs from the DEGIRO Core Selection? Let me know. Of course, this isn't all-encompassing. There will be things that I've forgotten. That can always happen, so feel free to add anything where needed. And of course, also keep in mind other things like taxes. And of course, as I mentioned, don't just focus on ETFs within the DEGIRO Core Selection, because there might be better ETFs available that you just can't buy in the Core Selection. Also follow our channel Happy Investors and our website for free downloads of stock books and ETF books. And also our newsletter for regular interesting updates that could actually give you very high returns, just like it has in the past. But yeah, no guarantees for the future, of course.